How's it, traders? Welcome back to Paradime Flip. Hope you're all doing well. Today we're going to be continuing our market structure course, and in this video we're going to be going deeper into market structure. Okay, and if you haven't watched the previous video, I suggest you do. Right, I'll link it up here. Okay, so you can stay up to speed on what's going on. Right, so in this video we're going to go deeper, and what we have in front of us here is Wykoff logic. Okay, so this is the idealistic view of market structure in the lens of Wyckoff. Right, and if you notice, right, the market, and if you notice that this picture identifies the various phases within the market, right? And you can see that we have a trending mode, and from a trending mode we go into a corrective mode, right? And these corrective modes are basically your accumulation areas, right? And once this is done, the market will trend, right, until it reaches another area, right, of accumulation, right, or distribution, okay? And at this point the market is somewhat sideways, okay? And from this phase we go back into a trending mode. Now, this is exactly what the market does, okay? And if we just understand what's actually happening in this picture, right, we can understand what's happening within market structure, because this is what market structure entails, okay? Now, it doesn't always look exactly the way Wyckoff schematics look, and sometimes it does, but not all the time, and it's not important that it does, okay? What's important is the idea behind what's happening, okay? And that's just for those who do look at Wyckoff and are studying Wyckoff, okay? You'll actually find that the schematics sometimes play out exactly and sometimes don't, but we are not looking for the schematics to play out exactly, right? What's important is the idea behind what's happening, right, in this picture, right, or the logic behind it. And if we just explain this picture, right, what we can see here is that in the first area here we can see the price is in a downtrend, right, and we reach what's called a selling climax, okay? Now, if we just think about what climatic action is, right, let's assume we are in this downtrend, right, and this downtrend is developing, okay, and what you are getting is obviously down candles. Now, if you think about what's happening inside these down candles, right, in terms of the order flow, right, we are getting selling coming in, okay, from aggressive traders, aggressive sellers, okay, and someone has to buy from these sellers, right, or provide the liquidity or take the other side of that trade, right? But who's doing that? It's most likely the market maker that's doing that, right? Sitting on the bid-ask spread, right, providing the liquidity, right? And what you get is a situation whereby you get sellers coming in, right, and obviously buyers or market makers providing the liquidity to those sellers. Now, the buying won't be as much as the selling at this point, okay? So the selling will overwhelm any buying coming in the market, okay? And if you just think about that, right, let's say for argument's sake, at this price point, okay, let's say we get a seller, right, and that seller is selling 10 lots, okay, so we got a 10 lot seller at this price point, okay. Now, let's say at the same price point, okay, we have a 5 lot buyer, right? Now, at this point, it's clear that the selling is bigger than the buying. So what's going to happen is that this buying, okay, is going to fill this selling, right? And if we have 5 buyers, right, and 10 sellers, right, the only volume that will be traded is 5 lots. So these 5 buyers will pair up with 5 of the sellers, right? And what you'll be left with is an additional 5 lots of selling that hasn't been filled, right? There's no buying that has paired this 5 lot selling, okay? So this 5 lot buyer, right, fills 5 lots of the selling, and we are remained with 5 lots of selling, right? And if no new buying comes in at this price point, what's going to happen is that price is then going to trade lower to a level where it can fill this 5 lot seller, okay? So it's going to trade to a level where it's going to rush to liquidity, right? Because at that area, right, that's where we can get a buyer for this 5 to pair with this 5 lot seller, okay? And as price trades lower, that'll attract more selling in the market, right? However, as price goes lower, right, the buying somewhat remains constant, okay, right? And the selling coming in the market, right, will overwhelm the buying, right? And it's the market maker providing the other side of this, providing the liquidity and taking the other side of this trade. So it's in their benefit, right, to not enter large positions, right, or large buy positions or accumulate large buy positions as price is trending lower, okay? Because at this point they are upside down, right, on their trade. And basically what's going to happen is that price is going to reach a level where it's overextended, and what you'll get is you'll get climatic action, right? And climatic action is basically high volume, right? And usually a large range candle on high volume. So if you think about it, throughout this period, as price is going lower, right, the volumes would have been somewhat constant, okay? They would have been small, some of them would have been a little bit large, but they would have been more or less constant, okay? And you reach a point where the volume increases drastically. And what this tells you is that the buying at these lower prices has now increased, okay? And let's say for argument's sake, right, there was a 50 lot seller, right, at this price point, and then it gets absorbed by a 50 lot buyer, right? Now the volume is 50 lots at this price point, and we get a spike in volume. Whereas throughout these price points, if we assume they were all constant, right, there was only 5 lots, 5 lots, 5 lots, 5 lots, 5 lots, 5 lots worth of volume traded at these price points, right? Even though we had 10 lot sellers, right? Right? If we are only getting 5 lot buyers at each price point, right, the volume will remain at a constant 5 lots, right? And as price cascades lower, the selling, right, will accumulate, the selling positions will accumulate, right? And that's what creates the momentum. And basically, it'll reach a point where someone steps in front of that train, right, with a large position and absorbs the whole position. Okay, and when you see that happening, they are doing it for a reason. Okay, and if you think about it from a market maker's perspective, it's beneficial for them to do this, right? Because if they are providing the liquidity and buying as price goes lower, they need to have a large position at the lowest point possible, right? So that when price pulls back, right, they can make a profit, right? Regardless of all these positions, right, that remain in a loss. Okay, so basically they have to average into their position, and they, as price goes lower, they have to buy more, right? And when they believe that price is about to turn around, or when we have reached the bottom, they will buy the most at that price point, right? And you'll get that that climatic action happening there. So that's basically what climatic action is, okay? And when you get this action, right, you usually get a reversal, okay, or you get a range. Now, in this picture, it's denoted by a range, okay? So we'll stick with this, right? And what happens is price goes into a accumulation phase, okay? And this accumulation phase is basically an area where now the market maker can make money, right? They can make their money rotating, right, in this area, okay? So in this area, the market maker is making its most money, and this is a zone where buyers and sellers are matched, right? So this is fair value, right? And it's fair value because buyers and sellers agree on this price, right? So if you think about this area here where price is trending lower, right, the selling does not match the buying, right? The selling is greater than the buying, right? And that's what's causing price to cascade lower until a point where now we get buyers and sellers, right, matched, right? And you can see that by an increase in volume, right, at that point. Okay, so that's the same thing here, okay, right? You got buying and selling, right, agreeing on the same price. And this accumulation phase, right, or this consolidation is also called volume. Now, this is volume because there is both buying and selling, right, taking place within this area. Now, if you actually just think about it, right, if you look at a single candle, right, whatever candle that may be, okay, and if we attach a volume indicator to the charts, right, and analyze the volume within that candle, right, whatever that volume is, right, is representative of the amount of trade that was taken inside that candle. Now, there are two ways to look at volume, and one is the standard volume indicator, And you also can use a market profile, which will show you the volume on a horizontal axis. Okay, so if we just go back to our accumulation area here, if I have to draw up a volume profile of this area, it would look something like this, right? Let me just make that thicker, right? And make it a darker color so we can see it. The volume indicator, the volume profile indicator, right? Or the market profile indicator, right? Would look something like this, okay? And it would peak in the area where there is the most volume, right? So that would be the area where price has accepted the most, and that would be the area where the most trade has actually taken place, okay? And if we also look at the volume profile of a single candle, right, there is an area within that candle, right, where there will be the most volume located, okay? And if you look at order flow, right, or you go on a lower time frame and look inside that candle, right, what you will see is that there's an area, right, where the most volume is in that area. Not to say that there's no volume at other price points, but the maximum volume, right, would be at the point of control or the area where the profile distribution peaks. Okay, so if you actually had to look at this candle on a lower time frame, what you may see is something of the sort, right? And this area would be the area of highest volume. Okay, and that is basically a accumulation point or a reaccumulation point or a distribution point, right, within this schematic. Okay, and in this accumulation area, right, because they're both buyers and sellers, there's actually a battle going on, right, whereby obviously sellers, right, coming in think that price is going to continue lower, right, and buyers are buying believing that price is going to go higher, right. There's also simple distribution of perhaps a move that had gone lower, right? The buying coming in could simply be distribution or getting rid of their position, okay, right? It could be any of these, right? All this is taking place within the balance area. Now, when the liquidity dries up at this area, in this balance area, price will then trend, right? Once again, okay? And what do I mean by that, right? When I say when the liquidity dries up, if you think about, right, what I explained in this area, okay, when I explained that you have for example, a buyer, let's say at this price point, okay, and that buyer, right, has 10 lots worth of buying, and you get a seller at that same price point, and that seller has 5 lots, right? In this example, okay, it's clear that the buying is greater than the selling, okay? So this selling is going to pair up with this buying, okay, and when it does that, this 5 lot disappears, and 5 lots from the buy side also disappears, right? But we had 10 lots worth of buying, so there'll be 5 lots remaining that has not been filled, right? And if there is no new selling at this price point, okay, basically there is no seller to fill this 5 lot, okay? So at this point, the liquidity at this price area or at this price has disappeared. And what's going to happen is that price is going to move higher to an area, right, where it can find liquidity to pair with this buying. Okay, so when the selling or when the liquidity dries up, right, at this price point, price then moves higher. Okay, so it's the same thing within this accumulation area. When the liquidity dries up in this area, price will then trend. Okay, and if you think about this specific example, right, we see that price actually trends higher. Okay, and if we think about these sellers, right, in this accumulation, right, it's evident that these sellers in this specific example, right, have lost the battle in this accumulation area. And all this selling that they have done in this balance area, right, is going to have to be unwound, right? Meaning that as price trades higher, right, that buying is actually driven by the unwind of these sellers, okay? So these sellers have to unwind their position, right, or get rid of their buy position, or they have to get rid of their sell position rather, right? And in order to get rid of their sell position, they have to buy, okay? And that buying is actually going to drive price higher, right? It's going to be a catalyst that drives price higher. And these buyers, right, at lower prices can now distribute, right, their buy position, okay, to all these unwilling buyers at higher prices, right? And that's exactly what's happening, right, in a trending move, right? And as price is going higher or trending higher, this is also going to attract new buying to step into the market, right, which will further drive the trend higher, okay? And this will go on until we reach a climatic point again, right? And the process repeats itself, right? And from this area, right, from this accumulation or balance area or two-way money or consolidation, price can either break higher or lower. And that's what's basically happening inside of the market, right, as it's making its swings, okay? So when you get your market structure, right, that's exactly what's happening in these areas, right? These swing points, right, are simply these accumulation and distribution points within a Wyckoff schematic. Okay, now these swing points could look like anything. They don't have to look like the schematic, right? So you don't have to get yourself caught up with nitty-gritties of it, right? Because as we go forward, I'll show you that you don't need to memorize exactly how these, if you've studied Wyckoff schematics, they can look a bit daunting, right? Sometimes they do look like the schematics, sometimes they don't, right? But as we go forward, I'll show you that it doesn't really matter what they look like. It's the idea behind what's happening inside this area that actually matters. And that basically concludes this video, and I hope you enjoyed this video, right? And you can check my description for all my links. And if you have any questions, you feel free to leave a comment below. Please hit the like button and subscribe if you want to stay tuned for future content. Okay, and I really appreciate your time, and until next time, stay safe.